Hi, welcome to FP&A Explained. This is Aparna Velichetti. In today's video, we will try to understand the core responsibilities of FP&A and what FP&A teams actually do on a day-to-day basis in any organization. The responsibilities of FP&A can be broadly grouped into few categories: planning, forecasting, performance analysis, financial modeling, and all these will lead to decision support. While the exact scope may vary from organization to organization, these responsibilities form the foundation of most FP&A roles. Planning is one of the most fundamental responsibilities of FP&A. This includes preparing annual budgets and long-term financial plans. During planning, FP&A translates business objectives into financial targets, such as revenue goals, cost limits, and profit expectations. Planning also supports efficient resource allocation, which in turn supports decision making. Let us try to understand planning in detail with a practical business example. This is an example from my personal experience. The management has decided to expand into new markets. What does FP&A do here? The role begins by understanding the business rationale behind the expansion. FP&A works with business teams to assess the expected revenue, the market demand, the pricing, and the customer acquisition. FP&A evaluates the cost and investment requirements, the capital expenditure, the working capital needs. FP&A tries to assess the financial feasibility of the expansion, the payback periods, and the potential risks. This analysis helps management understand whether the expansion is in line with the objectives. Another important responsibility of FP&A is forecasting. It is very closely linked to planning. While planning is establishing targets, forecasting is updating expectations based on actual performance. Forecasting helps management stay informed and adjust plans proactively. Here, let me share an experience of mine. In one quarter, revenue was originally forecasted at a certain level. When the quarter closed, actual revenue came in approximately 20% higher than the forecast. At first, we thought this can be treated as a one timer. But with time, the next quarter also has reported a 20% high revenue. At this point, we analyzed and reassessed the assumptions behind the forecast. Based on the analysis, what we concluded was that the original forecast no longer reflected business. As a result, we changed the revenue target. Thus, this example highlights how forecast helps in changing the expectations. Performance analysis. It is one of the key responsibilities of FP&A. It focuses on understanding how actual results compare to expectations. FP&A analyzes variances between budget, forecast, and actual performance. More importantly, it identifies the root causes behind those variances. The objective is not to explain what happened, but why it has happened. Let us now try to understand performance analysis with an example. As discussed earlier, actual revenue came in around 20% higher than the original forecast. The first step in performance analysis is to quantify this variance. How much of the performance is driven by revenue growth or any cost impacts are involved? The next step is to understand the drivers behind the variance. It is also important to assess whether any one time or non recurring factors have contributed to this variance. After identifying the drivers, FP&A evaluates the sustainability of the performance. If the performance improvement is sustainable, it may support higher future targets. If not, management may choose to treat that as one time temporary. This example gives us a sense of performance analysis. Financial modeling is another key responsibility of FP&A. Models are used to evaluate different scenarios and assess the financial impact of the potential decisions. Financial modeling helps management understand the risks and trade offs and the potential outcomes of the decisions. Let us try to understand financial modeling with a practical example. Let us say management has decided to acquire a new company. What does financial modeling do? It first creates the base model. The base model reflects the business as is without any changes. Then, FP&A tries to incorporate the revenue growth scenarios. Either the growth can be assumed to be conservative or higher growth. FP&A then includes the cost structure, and then it will add the one-time integration costs. Now it is in the hands of the modeler to play with the variables, to understand and answer the questions like how quickly the acquisition model becomes profitable, when will the cash flows turn positive, whether the acquisition strengthens the overall financial position. This practical modeling approach allows FP&A to compare different scenarios and support decisions. Ultimately, all FP&A activities feed into decision support. As we have been iterating throughout the videos, FP&A does not stop at reporting numbers. It provides insights and offers recommendations to the management. This enables leaders to take informed decisions. To summarize, the core responsibilities of FP&A include planning, forecasting, performance analysis, financial modeling, and decision support. These responsibilities of FP&A will help management in taking informed decisions. Let us meet in our next video. Thank you.